We can basically syndicate anything. Different asset classes are going to have different levels of risk. So these days, if somebody is syndicating, let's say, converting a mall to apartments, that's going to be a higher risk investment than somebody that's doing a stabilized multifamily syndication. That's going to be a different risk profile than single family houses. And so definitely think about the asset class that you're investing in to give you an idea of where the risk lies. Look at what the likely trajectory of that particular asset class. Right now, I think industrial, flex space, multifamily are very low risk over the next 5 or 10 years. If you were to ask me to invest in a retail project or a single family development project or a retail project, I'd probably consider the risk a good bit higher because those asset classes are likely to be more risky. So the first thing you need to ask yourself is, what's the asset class? The next thing you want to look at is, what's the exit strategy? And we talk about 3 kind of most common exit strategies in the syndication business. You either have the development project, which is ground up, and your exit is either after you've entitled the land or built on the land, you sell. The next most common, or the next in the list, is value add, where you basically take an existing property and you improve it. Either you improve it functionally from a physical standpoint, or you improve the management to increase the value. And then third is basically syndicating a completely stabilized property, something that's just fully renovated, just kicking off cash flow every month for however many years. 3 very good exit strategies, but they come with different levels of risk. I think it shouldn't surprise anybody that if you buy into a stabilized asset, let's say you buy a share of a skyscraper in New York, your risk is probably going to be a good bit lower than somebody that's developing land in some emerging market from scratch. So always look at the exit strategy that the syndicator is employing, and consider that certain exit strategies like development are going to be a higher risk than other exit strategies like value add or a stabilized asset. Number 3, always take a look at the ROI. So we tend to like deals that have higher returns, but we ignore the fact that higher returns are correlated to higher risks. There's a truism in investing, and that's that risk is, by definition, defined by the return. The higher the return, the higher the risk in the project. If an investor can offer a low risk return, people are going to be willing to be willing to invest for very small returns. And so the higher the return, the higher the risk. If you see a deal that's offering you 20, 25, 30%, not necessarily a bad deal, but most likely it's going to be a higher risk than a deal that's offering you 15 or 16 or 18% returns.
And risk in that sense isn't necessarily, it doesn't have to be the deal. It could be the operator.
100%. Yeah. So
like a brand new operator is probably going to have to give up more of the pie to mitigate that risk, right?
Absolutely. If some big name operator who's been in this business for 30 years goes to syndicate the exact same deal that I'm syndicating, they're probably going to command a lower return because they've built up trust, they've built up a reputation, and by definition, it's lower risk because they have been doing this longer and are probably better at it. Likewise, if I were doing it and somebody that's brand new to syndication were doing this, I could command a lower return than they could. So absolutely, the trust and the experience of the team goes a long way towards defining the risk of the project overall. But generally speaking,
everything you just said, sorry to interrupt, but everything you just said, it doesn't surprise me that you said it, having followed you for a while. It mirrors exactly what the world's greatest investors say. Ray Dalio, Steve Schwartzman, and others. It's all about risk management, managing the downside. Because if they can do that long enough, the averages play out.